Welcome back, grade 10s. Now let us look at our applications question. The first question says, elaborate on the meaning of a public company. The public company is a company that is registered to offer shares and stock to the general public through the JSE in order to raise capital. So when we talk of a public company, we are referring to the registered entity, a registered enterprise, which is registered to offer its shares to the general public. How are they offering their shares? Through the Johannesburg Securities of Exchange. Why are they doing that? So that they can raise more capital. Ownership of a public company is distributed amongst shareholders through free trade of shares and stock. So obviously when the shareholders buy shares in a public company, then it simply means that the number of shares that they are owning, then it simply means that it's equals to the amount of ownership that they have in that particular public company. So the ownership of public company is shared through the issue of shares to shareholders. So if you own 50% shares, then it simply means that you are owning that particular public company in a 50% proportion. So basically, it's easy for you, if you own shares in a public company, to sell them or to even transfer them to any person. Read the scenario below and answer the questions that follows. SPF Supermarket. Sybil, Promise, and Florence have started a business. They are jointly and severally liable for the debts of the business. They want to convert their business into a form of ownership which will enable them to invite the public to buy shares to raise more capital. Identify the forms of ownership applicable in the scenario above. Motivate your answer by quoting from the scenario above. So here's the scenario. It has two forms of ownership that we need to identify from it. Now let's go back to our scenario. It says Sybil, Promise, and Florence have started a business. So this is just information. They are jointly and severally liable for the debts of the business. So which form of ownership that says the owners of this particular form of ownership, they are jointly and severally liable for the debts of the business? It has to be a partnership, because with a partnership, these people, they are partners. They decided to start a business together. And remember, a partnership can be started by two or more people. So they are jointly and severally liable for the debts of the business, meaning all the debts of the partnership, they belong to the partners. So the correct answer would be a partnership. Moving on to the second statement. They want to convert their business into a form of ownership which will enable them to invite the public to buy shares to raise more capital. So which form of ownership enables the owners to invite the public to come and buy shares? So it is the public company. So with this statement again, it also informs us that this is a public. They want to convert it to be a public company, meaning they want to change a partnership to become a public company. Use the table below as the guide to answer question 2A. So here is the table. So obviously when we quote from the beginning up until the end of the sentence, we said it's a partnership because these individuals decided to come together and start a business that is going to make them to share or be responsible for all the debts of the business, which is a partnership. Then we said the other one, it's a public company because it's only the public company that can invite the public to come and buy shares in order to raise capital. Moving on to the third question, it says, explain the characteristics of a public company. A minimum of one person is required to start a public company. So if you want to start a public company, it does not need you to have many people to incorporate a company with. One person can start a public company. The company name ends with letters Ltd. So the name ending of a public company, it's limited or it is Ltd. Shareholders have limited liability and are not personally liable for the debts of the business, meaning personal assets of the shareholders cannot be taken or seized to pay for the debts of the business, which is a public company in this case. Advise businesses on the disadvantages of a public company. One of the disadvantages is that auditing of financial statements are compulsory. So whether directors of a public company want or do not want to audit financial statements, they are compelled by law to audit their financial statements because they are accountable to the general public since it is a public company. And those audited financial statements, they have to be published so that the public can see what's happening in that particular public company. Some shareholders may not exercise their voting rights, which result in choosing the wrong person as a director. So one of the disadvantages of a public company is that when it comes a time to vote for a person who's going to manage the public company, some shareholders may decide not to vote, and that could result in choosing the wrong person to manage the company. Directors may not be motivated to work very hard because shareholders decide on the directors' remuneration. So since it's not the directors who decide how much they should earn when they manage the public company, they may not be motivated to work very hard because they know that their remuneration will only be determined by the shareholders. Let us go for a quick ad break and we will be back.